Good afternoon, people of Earth. Good afternoon, everyone from Victoria, BC to Chilliwack, BC, to all points in between. This is the internet, so anybody, anywhere, anytime can tune in and drop out, I suppose. These are the COVID Chronicles, and I come to you from my now abandoned office on the sweltering west coast of Canada, outside of Vancouver, White Rock to be more specific. And first of all, let's do a quick update on the virus situation. Okay, so we are looking at 274,091 cases, 11,352 deaths, 90,000 recovered, which I suppose is good. And one thing, I had an earlier video and somebody had mentioned to me that the only reason the numbers of new cases, I had mentioned that the number of new cases was going up because there was more testing. And somebody took that as kind of an implication that it was overblown or exaggerated or, somewhat misleading, but that's actually a bad thing. It means they're testing more and more people and finding that they have the disease, they have the virus. So I shouldn't call it a disease, a virus. And that means there's a lot of people walking around that actually do have it. So let's take a look where these countries are right now. Pretty well all of them have reported their data. So if we look at Italy, Italy is really just, man, this country has really just been smashed. Nearly 6,000 new cases in the last 24 hours, 4,000 total deaths, 627 new deaths. I mean, people, this is not slowing down. This isn't slowing down at all, it doesn't look like. And I mean, Italy's had, they've had quarantine in place for a while now. And the deaths keep moving. And you know what, maybe they are all older people, but they sure are dying fast, right? Spain is another place that seems to be really hard hit. Germany has a very low death rate. So this is something we should dig into a little bit more. Why does Germany have the same amount of cases almost as Spain, and maybe 1/20th, 1/18th or so of the deaths that Spain has? Spain has 10 times new deaths in the last 24 hours as opposed to Germany. So the Germans must be doing something right. Iran, still quite a few. The US, nearly 5,000 cases. The US is really escalating quickly. I think we're seeing a lot of escalation in California and New York, especially. Those places have overtaken Washington. Washington State had started off as the early epicenter with an old folks home there. The UK also not looking great. Wow. Anytime you see this number of total cases and then new cases in 24 hours, anytime you see this number at more than, say, 10%, that means it's moving really fast. And this is about, 20%. So that's double. A place like Korea, I mean, Korea is like 1%, right? South Korea. So they've obviously gotten a good handle on the situation. Canada, we are approaching 1,000 cases. I think we have one disadvantage. Well, we have a few disadvantages, but we do have some advantages here. Our disadvantages are that we were extremely plugged into China, especially here in British Columbia and Ontario. That's why if we scroll deeper into the Canadian statistics, let's do that. I think we'll find that BC and Ontario are far and away the leaders in cases, both in cases and deaths here. Let's see if it gets to the individual provinces. 40 new cases in British Columbia. Yeah, 43 in Ontario. So that's March 18th too. March 19th, 40 new cases, yeah, 43 in Ontario. All right, so yeah, there we go. That's the state of things, right? Now, one of the questions I had from Terry McLean, good old Terry, watch for a video from us in the future, probably next week, Terry. The stock market. What a lot of people are hearing about the stock market, a stock market crash. They're hearing the Dow Jones, it's down X amount of points. What does all this mean, right? Okay, so here's a primer. If you're familiar with investing or the stock market, you can tune out now for the next few minutes. If not, if you're a newbie or you haven't had any exposure to it, this will give you a quick primer on what it is and how it all works. Okay, so when you hear the New York Stock Exchange, that is the exchange that is kind of the central hub that all the stocks are traded on. And when they're trading stocks, what they are trading is they're trading shares in companies. So initially, almost every company starts off as a private company, right? So you run this company, you have your owner, blah, blah, blah. You have your managers, people that work there, all that sort of thing. And you get to a stage where you want to raise more money. You want to grow faster. You have, let's say as an owner, you have 100% equity in this company. But I mean, 100% equity is no good until you actually sell it, right? Sorry, let me turn this off. This phone's blowing up again. Okay, so equity is only good if you actually sell your company. So if you don't want to do that, you can sell a portion of it off to an investor, or what you can do is what's called an IPO. An IPO is an initial public offering. That means X amount of shares of your company will be made available to the public or to anybody on a stock exchange, right? So let's say I had Acme toilet paper. Toilet paper has been in the news a lot. I started up toilet paper from my garage or my outhouse. I started up a toilet paper company. It grows, it grows, it grows. We're doing well. I distribute to grocery stores, and we're up to 5 million in sales, let's say. So I can say, you know what? I want to cash in. I'm tired of looking at asswipe all day. So I want to do an initial public offering. So what I would do is I would go to an accounting firm that would set me up for this. And it's very expensive. It's like, it'll cost something like $200,000. And basically they more or less control your financing and your books and your accounting so that it all complies with the regulatory standards. Whenever you make a company public, there's a lot different regulations that are involved to protect investors. So we will do this. We'll do an initial public offering. We're saying, yeah, 80% of the company, we're offering public shares, and it will list on the stock exchange, and people can buy it based on what they perceive the value of your company. So let's say I did this right before the big toilet paper crisis of 2020. I did a public offering, say for $1 a share, and then people are seeing toilet paper going through the roof, and everybody starts buying my share price will go up. Share prices are controlled by speculation and demand, or a lack of demand, right? But always speculation. So the value of a company goes up and down depending on what people think it's worth, right? And you have also things like dividends. This is when you pay out a portion of your earnings. So let's say, I've sold off 80% of the company, right? Public offering, people bought up my shares for $1. Hot industry, toilet paper, the shares climbed up to $2, $3. And people are saying, wow, this toilet paper is pretty good. I'm going to buy their shares. And they buy them at $3, $4. And they own those shares. They own a small piece of the company, right? And every, let's say, quarter, sometimes it's monthly, we look at our profit and our loss. And let's say we do $1 million in the first quarter. And of that $1 million, let's say $100,000 is profit. Let's say $200,000 is profit. So what I will do is I will say, okay, or our board of directors will decide to issue a dividend if it's a dividend paying stock. Not all stocks issue dividends. Some of them will just reinvest their profits back into growing the company. Others will create dividends. So we'll say, okay, this $100,000 of our profit, we're going to distribute that to the 100,000 dividends that we sold, right? Or 100,000 shares that we sold. So every share will get $1. And that happens every quarter. So you have the ownership in your share, and you get a cut of the income or the profit every 3 months, right? Okay, so that's how a company gets on a stock exchange. So let's get into the more advanced stuff here. So you will hear with the stock exchange. Hang on. Oh, I can still get low carb Monster, thank God. When this stuff runs dry in the gas stations, that's when shit's gonna get crazy. At least from my end. Okay, so let's look at stock exchanges. A lot of times you'll hear in the news the Dow Jones, right? What is the Dow Jones? The Dow Jones is like a composite. It's an amalgamation where they take a bunch of industrial stocks. You'll hear the Dow Jones Industrial Average. Not all industrial stocks, but mostly older blue chip stocks. I think like Coke is on the Dow Jones, things like that, right? And they have an average, right? The average of this grouping of companies. And the reason they do that is because this average of a group of companies is considered a great indicator of the stock market as a whole, or the economy as a whole, the American economy, if it's on the New York Stock Exchange. So they have the Dow Jones and they have the NASDAQ. The NASDAQ is the same thing as the Dow Jones, only it's smaller and it's more based on technology stocks. And they did this because they realized that technology stocks weren't exactly in lockstep with industrial stocks. Industrial stocks were more slow moving, less profitable, less growth oriented. Well, oh, sorry, not less profitable, less growth oriented and more kind of consistent when it came to profits. NASDAQ companies were much more speculative, again, and much more growth oriented because they tended to be in tech. And not every company listed on the NASDAQ is a tech company, but that is kind of the DNA of the NASDAQ is technology stocks. Okay, so here's what happens. The Dow Jones or the stock exchange or the NASDAQ, they're all connected. You have the New York Stock Exchange. Within that, you have the Dow Jones Industrial Average, which is a composite basket of representative sort of blue chip industrial stocks. And you have a NASDAQ basket, which is representative of tech stocks. What's happening now, for example, though, is all of these stocks are being affected by things in the economy and by investor confidence. So let's say you've worked your whole life and you put $200,000 into a stock. Let me find a stock here, okay? Let's say you're not really a super shrewd investor. You just kind of want to invest in things that you know and understand, right? So, hold on, my computer's crashing here. Okay, so let's say you bought stock in A&W. A&W, for those of you that don't know, is a fast food chain. They make hamburgers. They're basically, the same thing as McDonald's, let's say. Okay, so observe the screen here. Here's some information on A&W. Actually, this is pretty poor information. Let's find a different stock. But you can see on the chart here, this is the drop. Like this was February 11th. Yeah, started fading a bit. And then March, whoomp, the stock has fallen dramatically. Let's look at bank stocks. What's a bank? CIBC. Okay. So CIBC, here's a few key numbers. CIBC, the price of the stock right now is $51. It pays a $1.10 dividend, right? So every 3 months, you get $1.10 for every share that you have. The dividend yield is 8.6%. That is really high for a bank stock. Banks are very safe. But let's take a look at the performance of this stock. Over the last, let's say 1 month, say 3 months. Okay, so this is how it has performed over the last 3 months. Consistent. You can see banks are extremely consistent But right around February, right around a month ago, things start to wobble a little bit. Things start to wobble. They start to kind of dip. This is right here. this this is a good indication that somebody has either some foresight or some inside knowledge, right? Because a portion of the market is getting out of the stock at this point. And then you can see it starts falling more. And then here we go, one day, womp, way down here, stabilizes a bit, womp, way down here. It peaks up. This is because Donald Trump probably made a speech on that day. Yeah, that was a week ago. He came out and he made a speech. So it rallied a bit and then womp. Now it's back down even lower. So this stock is crashing. Now, why would this stock crash? Well, because the economy as a whole is crashing and banks are really intricately tied to the economy as a whole. People can't pay mortgages. They can't pay loans off. They're defaulting. If they're going to default on their mortgages, businesses are going to default on their loans. Credit cards are going to be kaput. You know, all of that stuff. It just totally capsizes the profitability of the stock, right? And the reason that the stock is dropping like that is people realize that they need to get out of it, or because the value is inflated and it's not where it is. And a lot of times when you think of the stock market crashing, and this is crashing is just a sudden drop, right? And what they have in place now is they have circuit breakers that trip. I think it's if the stock market as a whole falls more than 15%, boom, the circuit breakers trip and they halt trading. And this is designed as a safety, as a kind of a panic button, so that the market can't crash too much and too quickly. But here's what you have to remember. It's tempting to think, okay, so there's some asshole on Wall Street wearing a suit with a pocket watch and, a monocle, smoking a cigar, laughing at the rest of us, right? And if he loses a couple millions from his billion-dollar pile, nobody gives a shit. But the reality is, a large portion of the stock market are pensions, retirees, people's savings, right? And if that loses, a lot of people, like people that I would say that are in maybe their mid 50s and over, they're probably never going to be able to recover that money. Like if they had a portfolio that was, say, $400,000 or $500,000 planned for their retirement, and all of a sudden that's down to 250, they're fucked. They're not getting that back. So yeah, I mean, and pretty well every stock is going to drop. I mean, there's going to be exceptions, right? Because in these kind of situations, there's always opportunities that present themselves, but there's not going to be a lot of exceptions. And you have to remember the economy is so tied to everything else now. That's one of the problems with globalism, is everything is linked to everything else. So nothing can really stand on its own, right? Like you may think, hey, it's a great time to invest in Charmin toilet paper. But what if Loblaws, the grocery chain, goes under? Where are you going to buy Charmin? Or what if the transport companies can no longer operate trucks? Who's going to get the Charmin to the stores, right? So that's what I mean when I say it's very independent. Maybe some of them are manufacturing over in China, right? And maybe they can't get workers. Maybe their workers are all quarantined. There's lots of little things that can disrupt even something that looks like it's a sure bet in a recession. So there you go. That explains a little bit about the stock market. It explains a little bit about what a crash is. A bear market is also a market that's in decline and below the perceived value. A bull market is a market that is growing, right? And we've had a bull market for probably 10 years now. So one way or the other, there was a correction coming. I'd say the market probably was really inflated, and the air is coming out of that balloon, and probably even then some. So I hope that helps. That is a quick explanation of the stock market. Invest wisely, my friends.